The world has become more globalized than ever. It has become very common to live and work in other countries that are not your homeland. When it comes to investing, this can cause a lot of confusion as to where you should be paying your investment tax liabilities, such as capital gains tax. For example, you may be born and reared in Ireland and started investing here and then moved off to Canada or Australia. When you sell your investments, then who do you actually owe the tax to on any profits that you made? Similarly, you may have been living outside of Ireland and started investing and then moved here and are wondering the very same thing. The general rule will be that you only really create a capital gains tax liability whenever you actually dispose of your stocks or your crypto. It is at that time of disposal where you need to try and assess your tax residency. To do this, you will need to understand the Irish rules for what it means to be a resident, ordinarily resident and domiciled in Ireland. In this video, I'm going to explain what these are, and then I will go through all of the different scenarios so you know what applies to your situation. First off, to be considered a resident in Ireland, you need to be in the state for 183 days in that particular tax year. Also, if you have been in Ireland for a combined 280 days between this tax year and the last tax year, with a minimum of 30 days in each, then you will also be considered to be a resident in Ireland. If you are in Ireland for any part of any day, then it is considered towards your total. Next up, you become ordinarily resident in Ireland once you are resident in Ireland for 3 consecutive years. So if you spent 183 days or more in Ireland for 3 consecutive years, and the 4th year, then you will become an ordinary resident. If you then decide to leave Ireland, it will take another 3 years to actually lose this ordinary resident status. And lastly, let's talk about domicile. Everybody has a domicile of origin at birth, which is usually the domicile of your father. Now, you can actually change your domicile if you leave your home country and intend to never return to it and intend on permanently living in the new country you have chosen, then you will be able to meet the criteria of changing your domicile. Now that we know what it means to be resident, ordinary resident and domiciled in the country, we will be able to use these statuses to try and ascertain where you should be paying your tax liabilities on your investments. Let's go through all of the different scenarios now to see how it works out. So the first one we were going to have a look at here is if you are an actual resident in Ireland. So there are 2 different scenarios here. You can either be a resident and domiciled or a resident but not domiciled. So if you are a resident and domiciled, which probably most people are in Ireland, then all of your tax liabilities are due to the Irish tax authorities. Simple as that, there is no real confusion. If however you are a resident but not domiciled in the country, then you have to pay Irish capital gains tax on any disposals of assets situated in the state. Also, you may have to pay Irish capital gains tax on gains profits that have been remitted to Ireland from worldwide. So that means if you have investments sitting in another country, you may only have to pay Irish capital gains tax on those if you remit the profits back to Ireland. So that may be an interesting one for anybody who has moved to Ireland from elsewhere. Next up, if you are ordinarily resident in Ireland. So as we said, this is somebody who has been a resident in Ireland for 3 consecutive years. If you leave Ireland and go to Australia or someplace, you are still going to be an ordinary resident of Ireland for 3 more years. So in your first year living abroad, you would become ordinarily resident in Ireland and you still would be domiciled in Ireland. So you would be liable to Irish capital gains tax on your worldwide profits while you remain ordinarily resident in Ireland. If however you are ordinarily resident in Ireland but you are not domiciled, you will continue to be liable for Irish capital gains tax while you remain ordinarily resident on your profits, just on your profits which are remitted to Ireland. So again, if you are from elsewhere and had been living in Ireland for a couple of years and then decided to go back home, although you would remain ordinarily resident and still due to pay Irish capital gains tax, but it's only on your gains and profits which you have sent to Ireland. So if you had sent them back to your home place, then you wouldn't have to pay Irish capital gains tax on them. Now the next situation is where you pay tax on investments if you are neither resident or ordinarily resident in Ireland. So if you are neither resident or ordinarily resident in Ireland, you will not have to pay Irish capital gains tax on your investments. However, there are certain situations where you would have to pay CGT, but these do not relate to stocks and crypto. You would be obliged to pay Irish CGT on land and property in Ireland. Also on unquoted shares, so these would be like shares in private companies. So in summary, you only really create a tax liability whenever you dispose of your investments, and at that point you need to assess where you are a tax resident and where the money has been remitted, and that will decide where you actually have to pay your tax. So that was a lot to go over in a short space of time. I will leave a link to this article, which is on my new website called irishfinancial.ie. I'll leave that below in the description section if anybody wants to read through it in a bit more detail. I know I went through it a bit too fast, but I hope this cleared up a lot of questions. It's one I've got a good few on over the last year, so I'm glad to finally do a video on it. So thanks very much for watching, everybody. I hope you enjoyed the video, and if you did, please make sure to subscribe to the channel.